Welcome to the deep dive. All right, for this session, we're really zeroing in specifically for you ACCA students getting ready for the financial reporting exam. We've got the syllabus, the study guide, and this visual overview for what's often called Chapter 11, our mission. Pretty straightforward. Unpack the essential accounting rules for intangible non-current assets. Section B.2 in the guide, Chapter 11 in this overview here. Think of it as a focused revision session.
Exactly. Intangibles, they're a big deal in financial reporting, sometimes complex. Applying IAS 38 needs, well, careful thought. So we'll break down the core stuff right from your study materials, highlighting what's really important for your understanding and, of course, for the exam.
Okay, so grab your notes if you have them, get comfy, and let's dive into the world of assets you can't actually touch. Right, let's start at square one. What are we talking about here? The visual overview kicks off with IAS 38's scope and definition. So what defines an intangible asset?
Well, the fascinating thing and the big difference from, say, buildings or machines is they lack physical substance. They're non-monetary. But just lacking substance isn't enough. The standard, IAS 38, lays out three key criteria. It has to be identifiable, it needs to be controlled by the entity from past events, and you've got to expect future economic benefits to flow from it.
Identifiable. Okay, what does that mean specifically? Because, things like a company's great reputation or maybe its skilled workforce, they feel intangible. Are they covered?
Good question. That hits the nail on the head regarding identifiability. IAS 38 clarifies this. An asset is identifiable if it's separable.
Separable, meaning you could sell it off.
Exactly. Sell it, transfer it, license it, rent it, exchange it either on its own or with something related,
Yeah.
or alternatively, it arises from contractual or other legal rights. And those rights don't necessarily have to be transferable or separable themselves. So think patents, copyrights, software, licenses, maybe even customer lists if they meet the criteria. These often come from legal rights, or you could, in theory, separate them. But general reputation, or just having really skilled staff, usually no. They aren't separable in the same way, nor do they arise from a specific contractual right the company controls, like a patent does. So typically, they don't meet that identifiable test under IAS 38.
Right, okay, that separation or legal right point is crucial. Makes sense. What about goodwill then? That feels intangible, but you mentioned it's treated differently. The study guide hints at that.
Precisely. The visual overview makes that distinction clear. Goodwill, specifically purchased goodwill that arises in a business combination, well, that falls under a different standard, IFRS 3. It's basically the leftover value, representing future benefits from assets you acquired but couldn't individually identify and recognize separately.
So IFRS 3 for that kind of goodwill.
IAS 38 is for other intangibles, whether you bought them or generated them internally. And the study guide wants you to know the treatment for both types, purchased and internally generated. Purchase ones are usually, let's say, a bit more straightforward.
Got it. So we know what qualifies. Now, how do we get it onto the books?
Recognition and initial measurement, what are the hurdles here? Okay, so this links back to the basic principles in the conceptual framework. You recognize an intangible asset on your statement of financial position if, and only if, two things are true. One, it's probable that the future economic benefits expected from the asset will flow to the entity. And two, the cost of the asset can be measured reliably. Both have to be met.
Probable benefits and reliable cost measurement. Probable. Does that mean like more likely than not?
Yes, generally in IFRS, probable means more than a 50% chance. It needs some judgment, obviously, based on the facts at the time, and reliable cost measurement is key. For something you buy, it's usually simple enough purchase price, plus any costs directly needed to get it ready for use.
Like buying a patent, you'd include the purchase price, maybe legal fees.
Exactly. That's your initial cost for a separately acquired intangible. Now, the visual overview also flags subsequent expenditure.
Ah, yes, spending money on it after you've got it.
Right. And IAS 38 is pretty tough here. Generally, any money you spend on an intangible after it's recognized just gets expensed through profit or loss. Unless it's probable that this extra spending will actually boost the future economic benefits beyond what you originally expected, and you can reliably measure and attribute that specific spending to the asset.
So just maintaining it, like keeping a brand known, that's usually expensed.
Usually, yes. It's quite rare for subsequent expenditure to be capitalized. The bar is set high.
Okay, that clarifies things. Now let's tackle what feels like a really tricky bit. Internally generated intangibles. I mean, how on earth do you reliably cost something you made yourself? Or judge the probability? The overview highlights this, including research and development.
Yes, this is a critical area. and often tested, as you might expect. The study guide emphasizes the treatment here, especially for R&D costs. IAS 38 make a very important split between the research phase and the development phase.
Okay, research versus development. What's the difference and why does it matter so much for the accounting?
So research is like the initial investigation phase.
Mhm.
You're trying to gain new scientific or technical knowledge, but you don't have a specific product or process in mind yet. It's exploratory. Development, on the other hand, is when you take those research findings or other knowledge and start applying them to a specific plan or design. You're aiming for something new or substantially improved, a product, a system, whatever, before you actually start commercial production or use.
Right. Research is exploring, development is building.
Kind of, yeah. And the distinction is vital because of the uncertainty. In the research phase, it's generally seen as too uncertain whether any future economic benefits will actually materialize. Because of that uncertainty, IAS 38 says all expenditure on research must be expensed as incurred, put straight into profit or loss. No ifs, no buts.
Always expense for research. Okay, crystal clear. So development is where you might be able to capitalize.
Yes, by being the operative word, development costs can be capitalized, turned into an asset on the balance sheet, but only if the company can demonstrate all, and I mean all, of 6 specific criteria.
6 criteria. Okay, let's hear them. This sounds important.
It is. First,
Yeah.
technical feasibility. Can you actually finish making this thing so it's usable or sellable?
Okay, technical feasibility. Makes sense.
Second, intention to complete. Does the company actually plan to finish it and then use it or sell it?
Intention. Right.
Third, ability to use or sell. Okay, you intend to, but can you?
Yeah.
Is there a way to actually benefit from it?
Ability. Got it.
Fourth, how it will generate probable future economic benefits. You need to show there's a market for it, or if it's for internal use, how it will be useful. Basically prove it's going to bring value.
Okay, showing the future benefits.
Fifth, availability of resources. Do you have the technical know-how, the money, the people, everything needed to actually finish the development and then use or sell the asset?
Resources. Yeah, that's practical.
And finally, sixth, ability to measure the expenditure reliably. Can you actually track and measure the costs spent specifically on this development project?
Wow, okay. Technical feasibility, intention, ability, future benefits, resources, and reliable measurement. That is quite the list. You have to meet every single one.
Every single one. If even one of those 6 criteria isn't met at any point during development, then that expenditure has to be expensed. You can't capitalize it. It forces companies to be quite prudent.
Oh.
Only capitalize when success looks really likely and you can properly track the costs. And remember, applying these criteria in a scenario that's level 2 in your study guide, application is key.
Right, application, not just listing them.
Yeah.
Okay, so let's say we navigate all that. We have an intangible asset recognized, maybe bought, maybe developed, and met all 6 criteria. What happens after that initial point? Measurement after recognition is next on the visual map.
Okay, so once it's on the books, the company needs to pick an accounting policy for measuring it going forward. IAS 38 offers 2 choices, much like IAS 16 does for tangible assets. You've got the cost model or the revaluation model.
The cost model, I'm guessing that's keeping it at its cost and then sort of writing it down over time.
Pretty much, yeah. Under the cost model, you carry the asset at its initial cost, less any accumulated amortization, and less any accumulated impairment losses. Simple, and it's the most common approach for intangibles.
And the revaluation model, is that like marking it to market value?
Sort of. It means carrying the asset at a revalued amount, which is its fair value at the revaluation date, minus any later amortization and impairment losses. But, and this is a huge but, you can only use the revaluation model if you can determine the fair value reliably by referring to an active market for that specific type of intangible asset.
An active market for something like a unique patent or brand name. Does that happen often?
Very rarely is the honest answer. An active market needs lots of identical items being bought and sold, readily available prices. Think stock exchanges. For most intangibles, brands, mastheads, patents, specific software, that kind of market just doesn't exist.
So maybe for things like taxi licenses or fishing quotas in some places, but not much else.
Exactly, which means, in practice, the revaluation model under IAS 38 is very uncommon. You'll almost always be dealing with the cost model in your FR exam.
Okay, cost model it is, most likely. Now, linked to the subsequent measurement is useful life. How does that play into things?
The useful life determination is absolutely critical.
Yeah.
It dictates whether you amortize the asset, and if so, over how long. IAS 38 says an intangible asset has either a finite useful life or an indefinite one.
Finite or indefinite, okay.
If it's finite, meaning there's a limit to the period over which you expect it to generate cash inflows, then you amortize its cost, or revalued amount if applicable, systematically over that useful life. Amortization is basically the intangible equivalent of depreciation for tangible assets. You pick a method, usually straight line, and allocate the cost over the years you expect to benefit.
And indefinite. If there's no foreseeable limit, does that mean you just don't amortize it? Ever?
That's exactly right. If you assess an intangible asset as having an indefinite useful life, perhaps a brand name you intend to support and maintain forever, then you do not amortize it. But, and this is important, that doesn't mean you just leave it on the balance sheet at cost forever without checking its value.
Okay. So if you're not reducing its value through amortization, how do you account for potential drops in value? Which brings us neatly to impairment, also on the map.
Precisely. Intangible assets with indefinite useful lives, because they aren't being systematically amortized, must be tested for impairment at least once a year, and also whenever there's any indication that they might be impaired.
Annually for indefinite life assets. What about finite life ones?
Finite life intangibles, the ones you're amortizing, only need an impairment test if there's an indicator of impairment. Maybe a competitor launched a better product, or the technology is becoming obsolete, something like that. This whole area links to IAS 36 impairment of assets, which is another key standard.
And the test itself, how does that work?
You compare the asset's carrying amount, its value in the accounts, with its recoverable amount. The recoverable amount is the higher of two things: its value in use, what you expect to generate by using it, and its fair value, less costs to sell, what you could get if you sold it, minus the selling costs.
Okay, carrying amount versus recoverable amount.
If the carrying amount is higher than the recoverable amount, the asset is impaired. You then have to recognize an impairment loss in profit or loss to write the asset down to its recoverable amount. It stops assets being carried at more than they're actually worth. Goodwill impairment testing is similar, but has specific rules about cash-generating units.
Makes sense. Ensure assets aren't overstated. And the last box on that main path is derecognition. When does it come off the balance sheet entirely?
Derecognition is pretty straightforward. It happens either when you dispose of the asset, like selling it, or when you no longer expect any future economic benefits from its use or disposal. Maybe it's completely obsolete. When you derecognize it, you calculate the gain or loss as the difference between any proceeds you received from disposal and the asset's carrying amount at that time. That gain or loss goes straight to profit or loss. And finally, you see how everything on the visual overview sort of points towards disclosure at the end. That's because users of financial statements need transparency about these assets.
Right, disclosure. What kinds of things do companies have to tell us in the notes about their intangibles?
Well, IAS 38 is quite specific. You need to disclose the accounting policy's cost model or revaluation model, finite or indefinite lives. Critically, you need a reconciliation of the carrying amount from the start to the end of the year.
Like a movement schedule, showing additions, disposals.
Exactly. Additions, disposals, any revaluations, amortization charge, impairment losses recognized, reversals of impairment losses. It shows the whole story for the year. You also need to state the useful lives or the amortization rates used. And if you've decided an asset has an indefinite life, you need to explain why you reached that conclusion. There are also extra disclosures for revalued assets, and, importantly, you have to disclose the total amount of R&D expenditure that was recognized as an expense during the period.
Wow, okay. Quite detailed disclosures needed. So we've gone from definition, recognition, measurement, R&D, useful life, impairment, derecognition, right through to disclosure. That's covered the ground laid out in the study guide and overview. How does this all feed into the FR exam specifically?
Well, like we've said, IAS 38 is a core topic it will definitely feature. You can easily get objective test questions in sections A and B testing definitions, maybe asking if research or development costs should be expensed or capitalized in a mini scenario, or doing a quick amortization calculation.
So the shorter format questions test the basic rules.
Yes. But it's also prime territory for a Section C constructed response question. You might get a bigger scenario involving, say, acquiring a company and having to deal with purchased intangibles alongside goodwill, or a detailed breakdown of an internal project's costs, where you have to apply those 6 development criteria to decide what to capitalize.
Right, applying the rules to a messy real-world type scenario.
Exactly. And calculating impairment, dealing with subsequent expenditure, all fair game for Section C. Remember, you'll be using the computer-based exam tools, so practice setting out calculations clearly in the spreadsheet and explaining your reasoning in the word processor, referencing the IAS 38 criteria where needed. That application and analysis skill level 2 stuff is vital.
Okay, so practice applying the rules in those CBE formats is key. Well, we've certainly taken a deep dive into intangible assets today, following that Chapter 11 overview and the Section B.2 study guide requirements.
Absolutely. Getting comfortable with IAS 38 is crucial for FR success. It really tests your grasp of asset accounting principles and your ability to apply judgment, especially around R&D and useful lives.
Hopefully, this session has really helped cement some of those key points for your revision.
Definitely keep practicing those exam-style questions. Work through the criteria methodically.
And maybe just a final thought to leave you with, linking back to the bigger picture, the conceptual framework. Given how much judgment is involved in things like assessing technical feasibility or deciding if a useful life is indefinite, how well do you think the final numbers for intangible assets on the balance sheet actually achieve faithful representation, especially compared to something more concrete like cash? Just something to mull over as you continue your studies.